Hi traders, today I wanted to talk to you about the importance of risk to reward criteria and risk management. This is such an important area to figure out before you start your trading journey. Obviously, the first step is to find a strategy that works and to backtest it to confirm. We need to be able to confirm that your risk to reward criteria is going to be able to allow you to take your weekly trades with enough margin room that even if you have a fair few losses within the week, you are still finishing your week in profit. So let's get to it. So what is risk to reward? This is the management of the amount you risk per trade and also the key decisions that you make on where to place your stop loss and your take profits. This includes trade management and how you are able to manage your losses and your wins. So why is this important? This is everything, as the only way to win in the markets is to protect your capital by applying the right risk management techniques, such as only trading a lot size amount that you are comfortable losing, being able to accept the risk of trading and also understanding when to cut your losses short and knowing when to let your winners run. Without risk to reward, you cannot consistently make money, as you're just relying on finding one huge trade. However, by applying these techniques, it allows you to focus on small wins consistently over time, so that month by month you can be profitable. For example, if you have a 40% strike rate, but you're using a 1 to 3 risk to reward, risking 1% of your account, you will still be able to make money by the end of the month. This is what trading is all about. It's about understanding that the markets aren't guaranteed. No trade can be certain, which is why it's crucial to have your risk management plan on every single trade that you take to mitigate large drawdowns. So, how to figure out what the risk to reward is for you. The only way that this can be done is by testing the water, which means taking either demo trades or real trades to figure out where your pain threshold lies. If you enter a position and you feel uncomfortable, then that is a signal to lower your risk. And it's important that you keep doing this until you feel nothing at all whilst in a position. And no matter what risk size that is, you must start there and slowly increase with time. This will build both your experience and also your confidence. Your risk to reward truly just depends on what you have tested. If you have back tested over 100 trades just using the one pair and you finally understand its behavior and you figure out for this particular pair a 1 to 4 gives you a higher probability, then that is what you must stick with. But like I said, this varies depending on the pair. You're back testing your emotions and the session that you are trading. What happens if you don't stick to your risk management? It's very simple. If you're not willing to follow your own rules and protect your capital, then it's only going one way. Because how are you meant to stop making trading errors when you're not vigilant enough to stick to your own plan? Of course, you'll just end up blowing your account or losing so much money that you just quit. And then the worst part is, even if you don't quit, you'll just end up putting more money in. And you can see how this vicious cycle gets more and more addictive. So guys, remember, risk management is everything. The markets are all about probabilities, so protecting your capital is the number one importance. Every time that you look at entering a trade, am I risking the amount that I'm comfortable with? Is my take profit realistic? And is my stop loss in an area that I'm happy that if it hits that level, it invalidates my setup and I can walk away from the markets content? So guys, like, follow, drop us a comment and let us know if that did help you today. Any suggestions of anything you want me to have a look at or address next, do let me know. And check out our Instagram page for more daily hints and tips. Exo Funding.